most people think that stock market investing is about picking stocks. Like, how can you find the next Amazon before it becomes Amazon? That's one of the biggest lies out there, and it's one of the reasons why 90% of investors lose money in the market. There is a business for this on how to find the next big company, but there is a lot of time and energy and investment knowledge required to do this the right way, and unless you're planning on devoting a big chunk of your life to the stock market, this is not for you. If you get into this game, you're going to be spending a lot of money on how to find the next big stock pick, and the only person that's going to be getting rich on making these stock picks is the person selling these stock picks and not you. Look, stock picking is fun, and I think that can be a part of your portfolio because, it keeps things interesting, but do you know when the majority of people buy a stock? It isn't when no one's heard of this random company that's innovating, that's about to break out. It's after this company has already seen a huge run and now is on the news because it is the next big thing. But if you're hearing it on the news, you already missed the rally. I'm going to say this again. There is a way to find these companies and invest in these companies and make a lot of money doing that. But if your goal is not to spend a whole bunch of time trying to study the markets and become a professional stock market investor, then this is not for you. Stock picking takes a lot of time, and you need to know how to filter out your emotion, because emotion is one of the biggest killers on the stock market. But just because you shouldn't be picking stocks doesn't mean that you shouldn't be investing in the stock market. What you should be doing is investing in ETFs, exchange traded funds, that match your risk tolerance. You can think of an ETF kind of like a big group of stocks. Now, instead of you going out and just buying the McDonald's stock, you can buy a fund that is comprised of the McDonald's stock and the Disney stock and the Facebook stock and the Amazon stock. If you invest all of your money in the McDonald's stock and then people start going to McDonald's and they start eating fries and they find something really nasty in their fries. Ew, did you say they put guacamole in their fries? Wait, that's actually not a bad idea. Hypothetically speaking, if people found guacamole in their fries, then the McDonald's stock might go up because they're being innovative. But if people found something nasty like fingernails in their fries, then their stock might tank, and so would your investment. That's a risk you probably don't want to take, especially as a smaller investor, because now all of your money is invested in one company and you can't control what they do, so if they screw up, then you screw up. If you're looking for a way to just invest your money and grow your money, then you want to make sure that your money is safe as possible with big upside. Typically, you want to be investing in something like 3 to 7 different ETFs to give you exposure to different markets, but if you're just starting with $100, then 1 or 2 ETFs is plenty. You can add more into your portfolio as your portfolio gets bigger. Remember what I said in the beginning of this video about understanding your risk tolerance? Well, this is where understanding your risk tolerance comes in handy. There are ETFs for almost anything, and the funds that you invest in are going to depend on how aggressive that you want to be with your money. If you're looking for that stable and steady growth, then you should be investing in funds that mimic the general stock market. VOO and SPY are the two most common names here because both of these funds will give you exposure to the top 500 companies in the stock market. So if the stock market goes up, so will your fund. If the stock market comes down, your fund goes down. Before I go any further, let me just remind you, I am not telling you what to invest in, I'm just giving you examples because investing has risks. You are never guaranteed to make money when you invest. You might even lose money, so make sure you do your own due diligence and don't just blindly listen to a random guy on YouTube. Who you calling random, Jaspreet? If you want to be more aggressive with your money and you want a piece of some of the hot tech stocks out there, then you can look into investing in a tech ETF like VGT and OGIG. You can invest in startups with growth stock ETFs. You can invest in healthcare with healthcare ETFs, and you can invest in foreign and developing countries with emerging market ETFs. Now, you don't have to try to differentiate and fight between companies. You don't have to decide, should I invest in McDonald's or should I invest in Domino's? Now you can get exposure to a whole industry by investing in an ETF. Finding ETFs is pretty straightforward. All you have to do is go to Google and then enter in what industry you want to look in and then add the word ETFs. So if you want to find bank stock ETFs, just go to Google and search bank stock ETFs and you will see what there are out there. Plus, you'll be able to see which companies an ETF is invested in. That way you can see which companies you're getting exposure to by investing in a certain ETF. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.